we've talked about this. We did this step here on last week where we talked about how retained earnings is broken out between expenses and revenue. Revenue still carries the credit and expenses still carry the debit. All right, so we're going to have to keep that in mind as we go through the next phase. So just a quick refresher as we're getting ready to do journal entries. Assets increase with a debit, and that's the balance they typically carry. All right. Liabilities, credit, stockholders' equity, credit, common stock, credit, retained earnings, credit, revenue, credit. The only thing on the right side of the equation that increases with a debit is expenses, and we haven't done much with this, and dividends. That's a D for debit. Right? Everything else increases with a credit. The right side increases with the credit, the left side increases with the debit. All right? So let's look at our problems now. All right, so in November, Noodle Cake sold $3,000 of games in its online store. So what I'm going to be looking at is we're going to focus on the journal entry. So if I sold $3,000 of games in my online store, what is going to be my debit and what is going to be my credit? And notice this right here says cash.
Cash should be the debit.
Yep, cash. And a credit to?
Sales revenue.
Yep.
Or stockholders' equity.
Yep, sales revenue. And you want to do the revenue, even though it's going under stockholders' equity, now that we're doing journal entries, you want the specific accounts. So revenue is the right answer. All right, so that's your journal entry. Cash and revenue. Now, I will show it again here, so if you didn't get it completely written down, it's going to make me show all these wonderful. My focus, and on the next ones I won't do this, my focus now is on this right here, right? Every one of these PowerPoint slides is going to show you number 1 and it's going to show you number 3. But number 2 is the focus. You had one homework problem that you had to do on number 3. That's only because I couldn't take it out of there. T accounts will not be something that you'll be tested on. It's a teaching tool. And most of the time I'm going to give you the answers in the problems if we work them in class. I just couldn't take it out of that problem. So if you ever see it in homework, it's because I couldn't take it out of the problem. There's only one chapter, chapter 8, that I encourage you to use a T account. All right, next one. Noodle Cake received 3 $100 gift cards at the beginning of September. What's the journal entry there? Issued 3 $100 gift cards. So what are we going to do?
Cash would be the...
Okay. And notice what I'm doing each time. I'm going ahead and crediting 300, right? Then you just got to come up with the account name. And this one's a little harder. What's the account name? See if this helps you. Future services. So it means we haven't done it yet. So if we haven't done it yet, can it be revenue? I'll help you. The answer is no. It cannot be revenue if we haven't done it yet. So if it's not revenue, what was that other account I talked about? The new account you learned at the beginning. What was that account called?
deferred revenue.
There you go. Deferred revenue. And the reason it's deferred revenue is because even though we issued those gift cards, they have not collected on the service yet. So we haven't earned anything. We collected money, but we haven't earned anything. They haven't collected whatever it is they're going to do when they turn in those gift cards. All right. Next one, Noodle Cake sold $9,000 of apps on Google Play. This time it says they sold $9,000 of apps on credit. So how is this one going to be different?
Accounts receivable,
There we go. Accounts receivable and
sales revenue.
sales revenue. Yep. Accounts receivable and sales revenue. Just got to make sure you pay attention to that on credit or for cash. All right, Noodle Cake received payment on account for what they had sold on account to Apple and Google Play. So we received some payment. So what did we
That
get?
would be
Yep,
accounts
Okay.
receivable
as the debit,
Credit.
or as the credit. I guess.
as the, yes. Okay, I kind of helped you there.
Cash should be the debit.
Cash would be the debit, and accounts receivable would be the credit. Because in the last journal entry, we increased accounts receivable because they owed us the money. Now they're paying us. Okay. So see, accounts receivable. We got the cash. We received checks from that account. They're paying us. All right. Now, Noodle Cake wrote checks to employees for $7,800 for wages related to hours worked in September. What do you think?
Cash would be.
That should be credit, yeah.
Okay, cash will be credited.
Wages would be. Debit, credit. One of
Well,
them.
we wouldn't want to. It is one of them, right? Wages, and you want to be specific. Wages, expense. Yep. You couldn't have two credits, so you got to pick one of them. And remember, expenses are always going to be debited unless we're closing them out, which we'll learn about in chapter 4 in like an hour. All right, when we're finishing up. It's the last thing we do in chapter 4. And actually, it might be something you do on your own because it's smaller. But so wages, expense, and cash. All right, now on September 1st, Noodle Cake paid $7,200 in advance for rent September, October, November. So remember, you want to look for keywords, paid cash in advance. So kind of what you guys did on the last one. If we know we paid $7,200, what are we doing to cash?
Credit.
Credit, yep. All right. And then when you're doing homework, if you can set up the problem like this, you got 3/4 of it. Makes it a lot easier to come up with the rest of it. So what are we going to debit?
The rent.
The rent.
Prepaid.
Prepaid rent, exactly. PPR. If you're writing it out, you can abbreviate. On the homework, it will come up prepaid rent. Prepaid rent is an asset because technically, not legally, technically when you move in on September 1st, if you were to only stay 1 month, they would owe you 2 months of rent back. So that's why it's an asset. You only use it 1 month at a time. Again, we got a financial versus legal are two different things there. All right. And then Noodle Cake displayed online ads in September and then received the bill to be paid in October.
Accounts payable would be the debit.
Accounts payable's right, but accounts payable is what type of account?
Liability.
Liability, and liabilities typically are what?
Credit.
Right. So accounts payable is going to be the credit. What's going to be the debit?
Advertising.
Advertising what?
Expense.
Expense. Yep. Ad expense and accounts payable. They're both going up. We incurred an expense and we're going to pay it next month. think there's two more. Noodle Cake was notified by the bank that an automatic monthly payment of $600 was paid to the utility company for September. Electrical use for September. So what would we do
Supply
here?
expense?
What was that?
Supply expense?
I would probably just call it utility expense, because supplies usually means more like pens and pencils, that type of thing. So supply expense, and then what would be your credit?
Cash.
Cash, yep. Because it's an automatic payment that's coming out of your bank. Utility expense and cash. It wouldn't go, okay. All right, that was the last one. Then when you're done, it's going to look something like this. Really hard to kind of see, all right? But this is all the accounts, which is what you did a little one of your homework, listing all the balances and the assets. And then over here, you have your liabilities and your stockholders' equity. And now you add revenue and expenses, which we'll come back to in just a second. We'll come back to what will then be the last part of this chapter, which is the unadjusted trial balance. And you know what? We're just going to do it real quick so we don't have to come back in here. You take those numbers and you prepare what is called the unadjusted trial balance. It's the exact same thing you guys already did in that one homework problem. It's the first of 3 trial balances. All you do is bring in exactly those numbers I just circled as they appear. All your assets, then your liabilities, revenue, and expenses. The key is that your debits equal your credits. All right? That's the whole purpose of a trial balance, is to make sure your debits equal your credits. But if you look, it shows you the first bit is your balance sheet and the last bit is your income statement. And it just shows you how they get the numbers, which also those were the numbers I had circled. All right.